Thank you for tuning in to Investment Insight. One of everyone's favorite topics to talk about is the death tax, right? Everybody loves the fact of knowing that once they die, they get to pay another tax. And one of the things we were actually debating here before we started talking was what started it. And I was pretty confident it was the Spanish-American War was when the inheritance tax hit our shores in 1898. And if I'm not mistaken, the insurance companies got to opt out as soon as they passed that law. They had a really good lobbyist even in 1898. So if you think lobbyists just came around recently, you're wrong. So what are some options with inheritance tax? If we all know that right now it's
12.92 million, right?
12 million. So if you can give away $12,920,000 tax-free to your heirs, of course, some of that's going to expire.
Right.
Here, is it 26?
It is. We'll cover that. Yeah, you got it.
So it expires in 26, and so one of the things a lot of the politicians are talking about is, hey, most of the money in our country is in people over the age of 55 years old. And by the way, when you're dead, you're not voting anymore. So there's a very, very high chance that to pay off some of this debt, to pay for some of these deficits, maybe to balance Social Security,
Sure.
This may be one of the tools the government uses to tax people
Sure.
to get revenue.
Yeah.
So what are some options you can do to protect yourself from that inheritance?
No, you got it. Great. Thanks, Brent. Great to be with you all today. A little bit of history, or a little bit of what I call current history about where we're at as far as what is that lifetime exemption amount. Okay, amount a person can leave to a non-spouse and not have to worry about paying federal estate tax. Okay, you could leave $1 gazillion to a surviving spouse. We're not worried about estate tax then. But when we start leaving stuff to kids or again a non-spouse, that's when it potentially becomes an issue if your net worth is over a certain threshold. So that threshold for 2023, again, is 12.92 million, which isn't exactly a round number. Okay, I'll tell you, not long ago, in 2017, we were at 5.49 million a person. Okay, so quite a bit of change in a relatively short amount of time.
And things have really appreciated since then.
Sure, no doubt about it.
You think about it, what it costs to live now, it's a lot more expensive now, and properties have gone up. And so that makes it play here too.
You got it. So we got to this $5.49 million number in 2017 because in 2011, there was a base amount of $5 million indexed for inflation. Again, after 6 years, got us up to that 5.49, right? In 2018, though, we got a new tax law. Okay, new tax law that did hit on this. And that 2018 tax law, what it changed, it said that for our 2011 base, let's not have a $5 million number, let's have a $10 million number that's indexed for inflation.
Okay.
So after 12 years of inflation, up to where we're at now, that's why we are at 12.92 million, okay? But that 2018 tax law was not able to make this a permanent change, right? So we're going to keep, as things stand today, again, our default, if nothing changes, as things stand today, we're going to keep creeping up with inflation through 2025. But in 2026, if nothing changes before then, our 2011 base reverts from 10 million as it is now back to $5 million indexed for inflation. So right, we've got 15 years worth of inflation, so maybe we're at $7 million, something like that.
So basically, we've been growing at 10 million at inflation.
Right.
And in some weird, quirky way, we go back to 5 million as if it was original in 2011.
Correct.
Indexed for inflation till today. So potentially, we don't really know the number. The 5 million from the IRS could be 7 million.
With inflation, right.
With inflation,
right.
Or it could be this 12.92 million going further, depending on what they do with the law.
It depends on that. The default, though, right, to know is, hey, if nothing changes, it goes back to the 5. Right.
So we're basically going from a $12.92 million today to probably 7 million if that law was to expire today.
Sure.
So you're looking at losing almost $6 million in credit today.
That you could pass tax free.
To
your kids, either during your lifetime or when you pass.
Okay, because the other thing about that law is you're allowed to give the money away now before you die.
Sure. And we'll talk about strategies trusts will use to do that now before that exemption disappears and before assets become worth more than they already are. Because once you pass, if you get above these thresholds, your estate's getting hit with a 40% tax on that excess. And 40% is an outrageous number, but is lower than it has historically been.
So you're saying if you go $1 over, that $1 over, 40% of that dollar is gone.
You got it.
If you have $25 million and you're not married, You got $12 million at 40% gone.
See ya.
So $4,800,000 is just
You got it.
toast.
You got it. Right.
Okay.
Yep. You got it right on point. So, right, we're always thinking about ways we can get ahead of the game, ways that we can get proactive and best plan for this type of tax. So, we talked about other trusts and other sessions that are more so focused on other things. Some focused on income tax planning, some focused on asset protection. Those trusts, to kind of tell you how those are not exactly proactive today versus what we otherwise can do. Again, any trust you put in place during your lifetime, you've got at least 3 roles. Okay, you've got what's called a grantor. Again, that's who forms a trust, puts their stuff inside, right? You've got what's called a trustee. That's who's technically in charge of the trust. And you've got what's called a beneficiary, okay, who this stuff is for, right? As we talked about on previous episodes, when these two things equal, when grantor and beneficiary are the same, right? You're creating a trust for yourself, a self-settled trust. You're not getting proactive for estate tax reasons, okay? Whatever you put in there, it's still yours, okay? And it's going to be considered yours when you pass based on its value at your date of passing, and based on what your exemption amount is on your date of passing, not what it exemption amount was when it went into the trust.
So when you pass is what the number is based on.
Exactly right. So one type of strategy we'll use, and in this context, we're again going to keep using the married couple example, but one strategy we'll use to again get proactive. Don't let the assets continue to grow up. Don't let that exemption amount disappear overnight. That otherwise could have utilized. Is often through what's called a Spousal Lifetime Access Trust. Okay, so a SLAT for short is what
Spousal Lifetime Access Trust.
You got it. And I'll give
SLAT.
you SLAT.
Spousal Lifetime Asset Trust.
Access Trust. And I'll give you the background kind of why it's called that. Will make a little more sense in a minute. But again, backing up what I just said, when you create a trust for yourself, again, grantor, beneficiary, if they're equal, you're not getting proactive, right? So a simple way to get proactive, okay, might be that we have, again, in the context of a married couple, have the husband, be the one who technically creates a trust, okay? Have wife be our trustee, and then have just wife be the beneficiary of the trust, okay? So husband, he can take asset that's worth, we'll call it X dollars today, put it inside the trust, go ahead and use some of his exemption, okay?
So you can go ahead and use that exemption maybe before the numbers change.
Exactly right. Go ahead and use this exemption. You can give, again, you can give as much as you want to a spouse, and you're not worried about federal estate tax, you're not using exemption. If you want to structure a trust a certain way, you can do that as well. But here, we structure the trust to go ahead and use that exemption to make sure that it's not going to be part of wife's taxable estate either when she passes away. Okay, so what we do here.
So by doing that, you're giving to the trust now, and so that it won't go to your wife, it'll be owned by the trust.
You got it.
So the wife's not going to be involved for her numbers. It's different. And so just to hit on this again before I'm sorry, if you were going to move property, I guess you get appraisal for that property.
You can, right.
So if I thought, hey, in my mind, this building's worth $1.2 million, but the appraiser says it's worth $800,000, I would lose $800,000 on my credit, not the $1.2 million.
Absolutely right. So that's the more efficient way to do it, right? Use less of your credit. So, when you make we'll call it a taxable gift to the trust, and again, you're not paying any tax unless you give more than that exemption amount, okay? But when you make a taxable gift to the trust, you file what's called IRS Form 709 that tells the IRS about it, okay?
Oh,
and
cool.
And there's nothing in the instructions for that say, hey, you've got to get a formal appraisal for every asset you put in the trust, right? So if you got the property and you think it's worth X dollars, right? You could just say, well, hey, I think it's worth X dollars and not report anything. Does that, if there's no substantiation from an outside party saying, hey, we agree, or we say it's worth that, independent of the person who put it in, maybe that gives the IRS a reason to potentially audit that gift and see if it's worth more than if you had the formal appraisal with it. Just something to think through when you're making that gift.
But if you had that appraisal and you give it to you get the form to the IRS, and you've done this years before you die, I would think it'd be harder for the IRS to challenge it because you're like, hey, I told you in 2017 this is what I was doing.
No, you got it.
2024 is a long time from now. Why didn't you guys do something then?
You got an absolutely great thing to bring up. So part of the reason you do that in 709, you file the get tax return is, once you file that, all right, the IRS has a statute of limitations. They've got 3 years to put up or shut up.
Really?
If they don't fuss about it within that 3 years, they can't fuss about it down the road to say, well, hey, the valuation you used wasn't really right, wasn't correct.
So how did that work? Because in COVID, the IRS is so far behind on tax returns. So I'm sure a lot of people during that period used this opportunity because the IRS has not had the opportunity to get to stuff.
Sure. I mean, and that's, opportunity is a good word, right? So, I mean, if we're making gifts and things like that, and I would tell you, just from my experience, if you put something in, let's say, again, your exemption is 12.92, if you're not pushing real close to that limit, right, if you're not giving something that's really close to that limit, a lot of instances, even if the IRS audits it, it's not like it's going to turn into any more tax, right? It's just going to use a little more of your exemption. There's no more money coming into the coffers, if you will.
So like if I give away $800,000 property that they say is worth $1 million, I'm only using $1 million of my 12.92 million. So there's really no tax liability.
Not a lot of reason for them to want to audit something like that.
Yeah.
But kind of show you how this works, right? So let's say we've got an asset and kind of how it could play out, right? Let's say in 2026, things stay like they are, and we get our exemption down to $7 million. Okay. Let's say we've got an asset that the couple owns that's worth $10 million, right?
Yeah.
So husband, again, when we make a contribution to a trust, we want it to just come from the grantor spouse, right? So husband puts this $10 million asset into this trust, okay, which is going to use, again, it's going to use $10 million of his $12.92 million of exemption, which leaves, right, $2.92 million that we haven't used yet, okay? Because we went ahead and used exemption, because we structured the trust properly, this has gone from husband, right? He's not a beneficiary. So no matter what this grows to, right, this grows from $10 million to $20 million, it's not part of his taxable estate. He gave it away when it was worth $10 million and used $10 million of his exemption.
So any appreciation is not going to be subject to that 40% inheritance tax.
You got it. So, and then in the wife's context, okay, she did not create this trust. Husband did, right? So she can be trustee, and we'll say we've got these magic buzzwords for why it's supposed to come out of the trust for the wife's health, education, maintenance, and support.
So she can pull it out for whatever she needs.
If she needs to, right? But whatever is in this trust, again, because she did not create it, if this grows from $10 million to $20 million or whatever, it's not part of her taxable estate either when she passes. So it doesn't count against her $12.92 million of exemption. So
she can still use the money, but it's not subject to inheritance tax.
Sure. And so let's say it's cash, right? And let's say that cash is used, to buy a new home, right? So they buy a new home that's, owned by the trust. Right. She's the beneficiary. She can live at the property, of course, not paying rent, things like that. Because husband is married to the beneficiary, okay, even though he's not a direct beneficiary of the trust, while they're both living, husband gets spousal lifetime access, if you will, to what's in the
that's
trust.
why it's called a slap.
Right, and so he can live there as well, rent free.
So what you're saying there, of course, is because it's, say the trust name again, Spousal Lifetime
Access
Trust, even though he's not a beneficiary, because it's a Spousal Lifetime Access Trust, he still has the right, even though he's not a beneficiary, to use the money for whatever he needs.
While both spouses are living and they're married, he's still got that indirect access, if you will, to property, to assets inside the trust.
If his wife was to die,
that's when, right, there's risks that come along with this, right? The trust is not going to say, hey, now it's for husband. The trust is going to say, hey, now it's for the benefit of the kids.
Gotcha.
Right? So his technical indirect access, if you will, gets cut off once wife, if she happens to pass first. So, thinking through again, hey, if we're just going to do this, we just do one of these, have one spouse create this type of trust. We keep having morbid examples, but a lot of times we think through, right, which spouse is most likely to pass first, have that spouse be our grantor spouse. That way, surviving spouse does have that direct access, to what's inside the trust.
Cool. That's pretty cool.
Yeah. So again, estate taxes here. Estate taxes are our focus, get around the 40%. I'll tell you, if we're worried about estate tax, kind of one of the downsides I would suggest to this is from an income tax cost basis perspective. Okay, so let's say in our example, this asset is worth $10 million, and let's say it's something that had initially been purchased for $4 million, right? So that was the initial cost basis, right? Husband puts this property into the trust. Again, it's worth $10 million. Cost basis is $4 million. And again, let's say over time, when husband passes, it's worth now $20 million.
If you sell it,
yeah, you still got the same tax liability.
So you still got to pay capital gains.
Still got to pay capital gains tax. Because husband gave it away, right? He gave it away. It's not part of his taxable estate. It doesn't count anymore, if you will, against his exemption. But when husband passes, since this is not part of his taxable estate, there is no cost basis adjustment. Okay? And typically, by default, when wife passes, again, by getting it in this trust, it doesn't count against her 12.92 either. So typically, the default rules would say when wife passes, there's no cost basis adjustment either. Right?
So you don't get the step up, but you don't. So you might be paying 20% taxes in capital gains with 23.8.
Right.
But you're not paying the 40% inheritance tax or potentially a higher rate in the future.
Sure.
Because you could definitely see Congress saying, hey, if you got $20 million, you're quote unquote rich.
Right.
We're going to take half the money.
Right. Now you got it.
So you're at the capital gains rate. So
got
that's the downside is You got capital gains exposure here, but you're solving the inheritance tax exposure.
You got it. And so, great way to summarize. A couple more points on this one. Right, in our example, we gave away something worth $10 million. We'll call it in 2023 when we had $12.92 million of exemption. The laws are in place that, hey, if they reduce this down to $7 million in the future, okay, we're not in trouble. We don't have to pay any tax because we gave away more than what our exemption is now. We gave it away when we did have that much exemption, right? But we've already given away 10, so we don't have this extra 2.92 any longer. Okay, it's just we've already given away more than that amount. So when we pass, right, we don't have any exemption left.
So if you give away the $10 million now and they lower the threshold later, basically any money you'd have left would be subject. However, you would have saved $3 million that would have been subject anyway.
Exactly right.
Plus any growth.
Exactly right.
So this would be a great thing for maybe an asset. Maybe you don't plan on selling a family farm. That you want to avoid inheritance tax, but you're probably never. It's going to appreciate, but you may not ever be selling it. As an asset.
You got it. And I'll tell you another thing, especially an opportune time to think about this is as these laws may change, into 25, start of 26. But also, I'd say even potentially currently, okay, if you've got something that's worth X dollars, right? But you know that, hey, potentially with what could happen, it could be worth 5 times X, 10 times X, 100 times X here pretty soon. Being able to put it in the trust, have that valuation, have that, that third party look at it and say it's worth X today and report that to the IRS. Being able to do that before it really explodes in value, can make a big difference, as far as, not getting any bigger, if you will, in the eyes of the IRS.
So if you had like a startup company and you thought, hey, this company on paper might be worth $1 million, but you think it's going to be a $100 million company, this would be something that would make a lot of sense because you're setting your family up to where there will not be inheritance tax in the future because you're definitely going to be there.
You got it. And last thing I'll throw at you, this one, while the grantor's living, we keep things simple typically. This is structured to use the grantor's social security number as its tax ID. So as long as the grantor is living, we're not having to worry about any extra trust income tax return. It's all reported on the grantor's 1040, just like it's still owned by him or her. Okay, and I'll tell you, I would suggest that can be a further way to plan for this estate tax, right? So we give something away worth $10 million, right? And let's say we do sell it, down the road and have all this gain. In this case, let's say it's grown to $20 million, and our cost basis is 4, so we've got $16 million to gain to pay capital gains tax on, all right? Initially, okay, we can pay all that out of the stuff that's still in the grantor's name, okay, still that he didn't give away. We can initially pay it out of the money still in his individual name, further reduce what he's worth in the eyes of the IRS, from a taxable estate perspective, and preserve what we've given away over here. And that's not treated as an additional gift to the trust, okay? There's going to be typical language in here that if we need to reimburse the grantor for taxes he or she paid individually for the trust, that is at the trustee's discretion that we can do that.
So the trustee can, if there are tax liability for giving the gift, the trust can pay it.
And when you sell it, the trust can reimburse the grantor, for those income taxes paid. Again, the thought would typically be, let's keep more in here and let it grow and be preserved and spend down what's still outside the trust.
That way there's no inheritance tax liability.
But sometimes you need the money, right? Sometimes you gave away that asset that, you don't have other stuff, otherwise to pay that tax for, you still get the money to do so.
Because you're doing the gift, it would then be irrevocable at that point, right?
It is. It's irrevocable at that point, right.
And so are you allowed, if you didn't like this trust, is the trustee allowed to give some of the money to a different trust, or is it pretty much stuck in there once it's in?
So, you could, for example, you could give distributions to the wife if you need money, or the beneficiary spouse. You could take money out for certain reasons if you needed to do so. If you take it out, of course, you're in essence wasting some of that exemption you used when you put it in. So there's some strategy and some plan that goes into after you put it in place, kind of, we'll call it best operating procedure, just to make sure you didn't, waste things you already took advantage of.
Gotcha.
Yeah.
Because if you were to give it away, put it back in your name, you've already given this away, so now you've lost that inheritance tax liability.
You got it.
And now you're putting it back in your name, so now you get that liability still.
You got it.
And so that would be very inefficient.
Right. You don't get back the exemption you otherwise used previously.
So once it's done, you lose that exemption.
Right.
And you told the IRS you've given it away. But the benefit of that, of course, is you've got documentation now that you've given stuff away, and the IRS only has 3 years to challenge it. After 3 years is over,
that money they can't challenge the value used when you made the gift, what you said it was worth. You got it.
Gotcha. That's awesome, John.
Yeah.
Thanks for sharing us about the SLAT. And I still get the name wrong, but it makes a lot more sense why it's called what it is. But thanks for tuning in today for Investment Insight. We appreciate your time.
Thank you.